Getting a mortgage doesn't have to feel confusing, especially when you understand the key terms of how your debt service ratio or debt to income ratio is calculated. In this video, we're breaking it all down step by step so that you can move forward confidently in your home buying journey. We're going to start with a few key terms that you must know when you're talking about mortgages. The principal is the amount that you borrow from the lender. The interest rate is the cost of borrowing from the lender, which is normally quoted as a percent, and it affects how much you pay over time in your monthly payments, as well as the overall interest on the life of the loan. The loan processing fee is the amount that the lender charges you to do the admin work that is required to process the loan, and it is usually a one-off fee that is paid to the lender, irrespective of whether or not the loan is approved. The deposit is the upfront down payment that you make to the purchaser through your attorney. Typically, we're looking at minimum of 5% of the purchase price or higher for land. The loan term is how long you're given to repay the loan, which is normally quoted in years and maybe up to 30 years. Finally, there's your mortgage payment. When your loan is approved, the lender will allow you to repay on a monthly basis, and the mortgage is the monthly amount that you pay. While you pay a single, consistent amount every month, the payment includes a portion for the principal as well as the interest. And if you want to pay off your mortgage faster, you'll probably have to make extra payments towards the principal only. Let me know if you want me to break this out or explain it further in a future video. Now we're going to talk about your debt to income ratio or your debt service ratio. It's essentially the same thing. For this example, we're going to have someone who earns a monthly salary of $500,000. For ease, we're going to work with a maximum allowable debt to income or debt service ratio of 50% of the gross salary, which is $500,000. So that gives us $250,000 available every month to service all debts. Now, we're going to subtract your existing debts from that debt service ratio or that debt to income allowance. Let's say the individual has a credit card. Because the bank counts 5% of the limit of the credit card as your minimum payment, with this person having a credit card of $100,000, 5% of the limit works out to $5,000 per month as the minimum payment. This person also has a car loan with a monthly payment of let's say this person also has a car loan with a monthly payment of $75,000 and student loan with a monthly payment of $25,000. So the maximum mortgage payment you can qualify for is $145,000 per month. Now that you know what your mortgage can be, you can focus on getting the best loan terms, such as the interest rate and years to repay, as these will directly impact your mortgage payment. This is why it's important for you to get a pre-approval, as you may be looking for a loan to purchase a property for $30 million over 30 years with a deposit of 10% with a principal of $27 million, but an interest rate of 8% will give you a mortgage payment of $198,000 per month, but an interest rate of 5% will give you a mortgage payment of $145,000 per month. And this is how you will be able to qualify for a loan with these terms to purchase the property that you want.